So one of the ways that annuity salesmen try to frighten you into running to them for financial rescue is to attack bonds. Never mind that stocks and bonds have withstood the test of time going all the way back to the Great Depression. Never mind that bonds and stocks are the basic building blocks of modern portfolio theory. And never mind that every robo-advisor that I've seen recommends bonds and stocks, never annuities. But yet last weekend in Los Angeles, I heard this guy again, Greg Fox. And by the way, to be fair, he claims in his infomercials that he's not trying to sell you anything. He's just trying to give back. And as I mentioned in part 1 of my review, I don't believe it. I think somehow, some way, he must be recouping the cost of his infomercials. And if he's not the actual sales agent doing the annuity transactions, then he's directing people to someone else, and then Mr. Fox gets a cut. Maybe something like that. I don't know. And if I'm wrong, either way, it doesn't matter. He's on the air giving a grossly one-sided sales presentation like puffing up of annuities without educating listeners on the negatives about annuities. One-sided. Now, also on his SoundCloud page, it says, Greg Fox's successful career in radio started as a... Wait a minute. If you're paying the radio station to air your infomercials instead of the radio station employing you, in my book, that's not a radio career. The beginning and end of his so-called radio show is preceded and followed by an announcement that says, this show furnished by Gregory L Fox Insurance. I'm pretty sure that furnished by is code for this airtime paid for by. It's gotta be a commercial advertisement with the ultimate goal of puffing up annuities after he presents his straw man arguments attacking Doug Andrew, Ken Moraif, etc. He's looking for indications of interest in index annuities to sell. That's my guess. So on the radio last weekend, he was bastardizing bonds in order to puff up index annuities. He was saying that you're on the table and rolling the dice with bonds. You're in Vegas, folks. And how did Mr. Fox pull this one off? He looked at individual bonds. Nobody should invest in individual bonds. Yet he's talking about how General Motors bonds became worthless after they were forced into bankruptcy, and he's talking about Washington Mutual. Straw man argument. And so then he leaps to conclusion by saying this bond stuff is a bunch of nonsense because it has significant risk in a downturn. No, it doesn't. You invest in a total bond market index fund like BND. Look at the history of the Barclays U.S. Aggregate Bond Index going all the way back to 1980. Oh my God, in 2013 it lost 2%. In 1999, it lost 0.8%. Oh, and this is the granddaddy of them all. In 1994, it was down 2.92%. This is catastrophic. By the way, notice how in 2013, stocks were up 32%. Stocks and bonds are like yin and yang. They balance each other out because money has to go somewhere. When stocks fall, money runs to the safety of bonds. Look at 1999. Bonds down slightly, but stocks had been on a tear for 4 years in a row. 1994 was a boring year for stocks and bonds, but look at what stocks did for the next 5 years. So then he goes on to ask on his radio show, now how many insurance companies went broke in 2008? Well, back in the 1990s, Executive Life Insurance Company, large and reputable insurance company, they went broke. And since then, there's been, I forget the number, I think about 62 other major insolvencies. But then annuity salesmen will say, well, there's a guarantee fund. You're protected. Well, actually, in California, that fund only pays 80% and only up to $250,000. And by the way, who has to pay money into that state guarantee fund? The insurance companies. And who do you think they pass off these costs to? Annuitants. It's baked into the products, like all the other expenses that are baked into these products, like Mr. Annuity Salesman's lavish commission. So what else? Mr. Fox crafted a list of what he calls ideal investment features, and clearly he created this list with a purpose of puffing up annuities, and he's bending the truth. A lot of his questions are basically red herrings like no market risk, or is it guaranteed, or shell games like no fees, or just plain like deceptive, is there a beneficiary option? But I mean, imagine this. He's been doing this for 48 years, and it never occurred to him that liquidity is a desirable investment feature. I'm not in the financial services business. I've been doing this for 0 years, and even I know that liquidity is hugely important. Remember this, no insurance salesman can predict if a client might need to get their money back. And how about annualized return on investment? Why isn't that on his list? Because sometimes people cash out of their index annuity before the distribution phase, and then they find out that accumulation value is not the same as cash surrender value, and that there's a 7 to 20 year surrender period protected by a massive surrender penalty. And sometimes people like to leave as much money as possible to their beneficiaries when they die. But Mr. Fox, who's been doing this for 48 years, it apparently never occurred to him that annualized return on investment might be an investment feature to consider. Clearly, he's trying to puff up index annuities. You know what he's doing? And this would be like trying to make a case for Ryan Leaf as a candidate for the NFL Hall of Fame. What are some ideal qualities of a Hall of Fame quarterback? Heisman finalist? Check. Top 2 draft pick? Check. Strong arm? Check. 20/20 vision? Check. Threw a minimum of 14 career touchdowns? Check. Was given the opportunity for drug rehab? Check. I mean, that basically encapsulates these ideal investment features. So what I did, I created my own, a real list of investment features, and wouldn't you know it, index annuities failed every single test, and index funds scored a 12 out of 12. So we already covered liquidity, healthy annualized return on investment if you need to cash out early, healthy annualized return on investment for beneficiaries during the time when you're taking income, gains taxed at the lower capital gains tax rate, adequate, that's adequate income later in life, not just income, and simplicity, no binding contract to sign, can be rebalanced as needed over time. At risk of loss of some of your principal if issuing company becomes insolvent. Conflict of interest, commissions. Sale of product is often a breeding ground for fraud. Well, there you have it. The annuity was 0 for 12, and index funds were 12 out of 12.